Welcome to the debate. What happens when the world's biggest banks are suddenly charged an 85% penalty for a practice that used to be completely free?
It sounds like a total shock to the system, honestly.
Exactly. Today, we are looking at a ticking time bomb in the global silver market. But before we break down the mechanics of this shift, I want to note that the conceptual framework and design for our intellectual exploration today is designed by Hot Hood.
Right. It is a highly effective lens for understanding a really complex global event.
Yeah, we are focusing specifically on the March 19th Basel III Endgame do-over. Basically, the Federal Reserve, influenced by regulators like Kevin Walsh, is completely rewriting the rules for how silver is valued and traded.
Right. And to understand just how huge this rule change is, we really have to define exactly what these banks are actually trading. Because, there are two very different types of silver in the financial system.
Oh, totally.
So first, there is what the banking world calls unallocated silver. But for our discussion today, we will just call this paper silver.
Keep it simple, right?
Exactly. It is basically a digital promise. It is a piece of paper from a bank stating you own a certain amount of silver, but the bank does not actually have that physical silver sitting in their vault.
Right. It's just pixels on a screen. And then you have allocated silver, which we will refer to as physical silver.
The real stuff.
The real thing, yeah. These are heavy, shiny silver bars with specific serial numbers stamped right onto them, locked safely inside a physical vault somewhere. And the bridge between these two types of silver is a banking rule called the RSF, or Required Stable Funding.
Which is kind of a mouthful.
It is. Simply put, it is a safety penalty. When a bank holds an asset that regulators think is risky, the bank has to lock up a certain amount of cash in their reserves just to prove they're safe.
Which brings us to the core conflict of today's discussion. The new rule from the regulators changes this safety penalty dramatically. Regulators are now charging banks a massive 85% safety penalty for holding paper silver.
That is huge.
It is. However, if a bank holds real physical silver, the penalty drops to exactly 0%.
Wow. Yeah. See, it is a deliberate trap. And my position today is that this 85% penalty on paper promises will force banks into an immediate, desperate panic. They will be forced to buy real physical silver just to survive, which will destroy the fake paper market and cause physical silver prices to skyrocket overnight.
Well, I look at that exact same rule, but I see a completely different outcome. The 85% penalty is absolutely designed to make the financial system safer by pushing banks away from digital illusions. But I argue that global banks will manage this risk smoothly.
Smoothly? Really?
Yes, smoothly. They will transition their assets into real, physical silver step by step, rather than suffering a total collapse or triggering some apocalyptic price explosion.
I just don't see how you can transition smoothly when the math turns against you this violently. Let's explain exactly how banks have operated up until now. Historically, banks paid almost a 0% penalty to create paper silver.
Right, they could basically just print it.
Exactly. They could sit at a computer and type 1 million digital ounces of silver into existence. And by flooding the global market with an endless supply of these paper promises, they essentially tricked the market into thinking silver was incredibly abundant.
Which artificially pushed the price of real silver down?
Spot on. It was a completely free tool for banks to control the market.
Right, because there was no cost to holding a digital promise on a spreadsheet.
Precisely. But the new 85% safety penalty flips that reality totally upside down. Let's look at the actual mechanics here. If a bank holds $100 million in paper silver today, this new rule dictates that they must take $85 million in real cash or expensive government bonds and lock it away in a reserve account.
They just have to park it there?
Just park it. They cannot use that money to make loans. They cannot invest it. It just sits there trapped. And in our current economy, where interest rates are high and borrowing money is incredibly expensive, locking up $85 million just to hold onto a digital promise is a crushing financial burden.
It is definitely expensive, yeah.
They simply cannot afford it. To survive, they have to dump the paper and scramble for physical silver, which carries a 0% penalty.
Okay, but your argument assumes they just drop everything on day one. And that completely ignores the reality of banking compliance timelines.
How so?
Well, let's look at why regulators chose an 85% penalty instead of a 100% penalty, or, just an outright ban on paper silver.
I mean, 85 is pretty close to 100.
It is close, but that gap matters. If the Federal Reserve wanted to destroy the market overnight, they would have just banned unallocated silver entirely. But they set the penalty at 85%. That specific number is designed for a controlled demolition.
A controlled demolition. Okay.
Yeah, it hurts just enough to force banks to change, but it leaves just enough room for them to unwind their positions slowly.
But a controlled demolition still brings the building down, right? How exactly does a bank, unwind slowly when it is bleeding cash every single day? Let me frame it with a really simple analogy.
All right, go ahead.
Imagine you're holding a piece of paper that says 1 silver coin. The government suddenly announces you must pay an 85-cent tax every single year just to keep that piece of paper in your pocket.
Okay, I am tracking with you.
But if you trade that paper in for a real silver coin, your tax drops to 0 instantly.
Right.
You wouldn't slowly plan your transition over 5 years. You would run to the store to trade your paper for a real coin that exact same afternoon.
Well, your 85-cent tax analogy highlights the incentive structure, sure, but it kind of oversimplifies how massive banks operate.
I think it gets right to human nature, though.
Maybe human nature, but not corporate banking nature. When a massive Wall Street bank realizes they are facing a crushing new cost, they do not just panic and sell at a massive loss.
So what do?
They start passing those costs on to their clients. They will look at the people buying the paper silver and say, hey, we now have to pay a high safety penalty to hold this for you, so we are raising your account fees.
Oh, so they just make the little guy pay for it.
Basically, yes. They will force the clients to absorb the penalty. And at the same time, the bank's risk department will slowly buy a little bit of physical silver every week. Over the course of a year, they quietly reduce their paper and increase their physical holdings without causing a sudden stampede.
Okay, but that logic relies on a really massive assumption, which is that the banks get to control the speed of the game.
They usually do.
Usually, sure. But you are looking at this as if the banks are alone in a vacuum. What happens when outside groups notice this huge vulnerability? That shifts us directly into the mechanics of a short squeeze and a delivery run. The big banks are not the only players on the board here.
You are talking about international exchanges and large institutional investors, I assume.
Yes, exactly. Smart money outside the Western banking system is watching this new rule very, very closely. Groups like the Shanghai Gold Exchange or massive industrial buyers, they know exactly what an 85% penalty means.
They can do the math too.
Exactly. They can look at the bank's balance sheets and see that they are weak, that they are trapped by this new cost. So these outside groups realize that holding paper silver is becoming incredibly dangerous.
So they want out?
Right. And what do? They call the bank and demand a delivery run. They say, we don't want your paper promise anymore. We want the real physical silver you owe us. Put it in an armored truck and deliver it to our vault today.
And you are arguing the banks do not actually have the physical silver to put in that truck?
We know they don't. That's the whole point. They have been printing paper promises for years precisely because they did not have the physical metal.
Well,
let me break down exactly how a short squeeze works mechanically in this scenario. Say the bank owes the Shanghai Exchange 1,000 real silver bars, but the bank only has 100 real bars in their vault. To meet the demand, the bank is forced to go out into the open market and buy 900 real bars.
Right, they have to source it.
But because everyone knows the bank is totally desperate, no one wants to sell to them at the normal price.
So the sellers just raise the asking price.
Exactly. The sellers demand double the price, and the bank has to pay it because they are legally obligated to deliver the metal. Then they need more, and the next seller demands triple the price. Because the bank is trapped in a forced buying situation, their own massive demand drives the price of physical silver up exponentially.
Okay, I see the mechanics.
It spirals completely out of control. That is a short squeeze. It is not a slow, managed unwinding at all. When the Shanghai Exchange demands delivery, It triggers pure panic.
Look, that paints a really dramatic picture, but it treats the smartest financial institutions in the world as helpless victims just waiting to be attacked.
They are trapped by the math.
But banks are the primary dealers in these markets. They have huge teams to manage risk safely. They saw this Basel III rule coming long before the Shanghai Gold Exchange started making moves.
Seeing it coming doesn't mean you can fix it.
It means you can prepare. If the rule explicitly rewards holding real silver with a zero penalty, the banks have a massive head start to become buyers of real silver first.
But having a head start does not magically create physical metal that simply does not exist.
No, but it dictates how they accumulate it. They aren't going to wait to be squeezed on the open market. They will use their massive market power to quietly buy up physical silver production directly from the mining companies before it even hits the open exchanges. They will lock in private contracts. Yes, the price of real physical silver will steadily rise as these banks accumulate it to avoid the 85% penalty. I am not denying the price will go up.
Well, that's something we agree on.
Right, but I am pushing back on the idea of a chaotic slaughterhouse where banks are caught completely off guard. It will be an orderly shift of capital from paper to physical.
Your orderly shift breaks down the exact second we step outside the financial sector and look at the physical reality of the modern world. Let's explore what happens when this sudden financial demand for physical silver collides with a massive real-world shortage. We are heading for a total decoupling of the paper price.
Okay, unpack what you mean by decoupling for a second. Sure.
Basically, the fake price and the real price splitting apart completely. Right now, the paper market dictates the price of silver, but we have massive, severe physical shortages of silver happening globally. This isn't just about jewelry or silverware anymore. This is about artificial intelligence.
The tech boom, yeah.
Exactly. Giant data centers require massive amounts of electricity. New electrical power grids, electric vehicles, thousands of acres of solar panels are being built every single day. And silver is the best conductor of electricity on the entire planet. You cannot put a digital paper contract into a solar panel. You need the physical metal.
I agree, the industrial demand driven by the technology boom is absolutely factual. It creates a very tight physical market.
So let's connect the two events mechanically. On one side, you have this new banking rule forcing Wall Street banks to scramble for real physical silver to escape the 85% penalty and satisfy delivery runs.
Right.
On the other side, you have the AI industry, electric vehicle manufacturers, and energy companies scrambling for real physical silver just to build their products. When you mix those two massive demands together, the banks simply will not be able to find enough physical silver to buy.
And that is where you predict the system breaks entirely?
It has to. Mechanically, it leads to a force majeure. This is a legal clause in financial contracts that essentially says an unstoppable event has occurred and we literally cannot deliver the silver we promised you.
It's the emergency exit button.
Exactly. When a bank declares force majeure, they tell the buyer, we don't have the metal, so we are just going to give you cash instead. And at that exact moment, the paper market fails. Everyone realizes that paper promises are completely empty. The paper price becomes worthless and the real physical price explodes into the stratosphere because tech companies will pay absolutely anything to get the actual metal they need to survive.
I understand the mechanism of a force majeure, but I strongly reject your conclusion that the paper market becomes worthless.
How could it not?
Because you're assuming that paper silver only exists as a tool for banks to manipulate prices. But let's look at why the paper market actually exists for legitimate businesses. Imagine a company that manufactures solar panels. They know they need 10,000 ounces of silver 6 months from now to build a new batch of panels.
Right. They need the physical metal for the factory.
Yes, but they do not want to buy it today and pay to store it in a giant warehouse for 6 months. And more importantly, they are terrified that the price of silver might double in the next 6 months.
Because if it does, their costs go up.
Exactly. If the price jumps, their solar panels become way too expensive to build and they go bankrupt. So to protect themselves, they use the paper market. They buy a digital paper contract today that locks in the price of silver for delivery in 6 months.
Hedging.
Yes, this is called hedging. Without paper silver to lock in prices, legitimate manufacturers wouldn't know what their costs will be. They need the paper market for stability.
But the new 85% rule punishes the banks holding that paper, regardless of whether a solar panel maker is using it for stability or not.
It penalizes the bank, yes, but regulators will not let the paper market go to zero because it would totally destroy the global supply chain for companies relying on those hedges. The Federal Reserve's goal is to connect the financial system back to reality. The 85% penalty is a strict bridge forcing that connection.
But it hurts the banks.
By making paper much more expensive to hold, the regulators force the price of a paper contract to rise until it actually matches the true, real-world cost of physical silver. It ensures that the paper represents reality again. It will be a painful, expensive adjustment for the banks, sure, but it is a healthy correction. It is not the end of the world.
Well, you see this rule as a bridge connecting paper and reality. I see it as a bridge being completely burned down, so everyone is forced to swim to the physical shore as fast as they possibly can. Let's boil this down to its core consequences and just summarize our positions clearly for everyone.
A final review of where we both stand on this fundamental shift makes perfect sense.
So here is how the mechanics of this rule ultimately play out from my perspective. The new 85% safety penalty is simply a math problem that banks cannot solve. They cannot afford to lock up millions of dollars just to hold digital promises.
Right.
Because of this crushing cost, banks must run away from paper silver. But as they try to exit, they are trapped. Factories desperately need real silver for artificial intelligence and power grids. At the same time, massive international exchanges are demanding the real physical delivery of their silver from the bank's empty vault. Because all of these players demand real physical metal at the exact same moment, banks will be forced into a mechanical short squeeze.
The panic buying you mentioned.
Yes, they will panic buy physical silver at any price. This forced buying will break the fake paper prices that have suppressed the market for years. The digital illusions will fail and the price of physical silver will skyrocket.
And here is how I see the mechanics of this transition. There is no question that the new rule forces a massive change in behavior. By assigning an 85% penalty to paper and a 0% penalty to physical metal, regulators are officially declaring that unallocated silver is dangerous and physical silver is perfectly safe.
A clear message.
Very clear. However, global banks are not careless victims. They employ massive risk management departments designed specifically to handle regulatory shifts exactly like this. Instead of a sudden, chaotic explosion where contracts fail and markets break, the banking system will execute a controlled transition.
Step by step.
Exactly. They will pass the penalty costs onto their clients and steadily accumulate real physical assets over time. The rule will successfully force the price of paper silver to match the true cost of physical silver. It is a strict, necessary cleanup of the rules to protect legitimate businesses, not an apocalyptic event that will destroy the financial system.
It really is a remarkable moment in financial history. We are looking at a single regulatory rule change, just moving a penalty on a spreadsheet from 0 to 85%, and it has the power to totally rewire the global balance between digital promises and physical reality.
It highlights just how interconnected global finance truly is. A safety penalty drafted by regulators in a quiet office directly dictates the cost of the silver going into a solar panel or an AI server halfway across the world.
Right.
There is so much more to explore in the source material regarding Basel III, especially when looking at exactly how regulatory rule changes quietly shift real wealth across the globe.
Oh, absolutely. We highly suggest our audience dig deeper into the source material to analyze those exact mechanics. So as we wrap up today, think back to the core incentive, an 85-cent tax on a piece of digital paper versus a 0-cent tax on a heavy physical silver coin. Whether the banks manage a slow, quiet walk to trade in their paper, or whether they are forced into a blind panic by a massive short squeeze, one mechanism is absolutely in motion. The era where banks could manipulate markets with free digital illusions is coming to a close.
Definitely.
We leave it to you to decide exactly how explosive that ending will be.